Hey, everybody, it's Steve Olson. Welcome to the Investors Corner podcast. I want to talk about something that I have been talking about a lot, but I think it's worth bringing up. Imagine, let's rewind back to late 2022. And if you recall, at this time, the Federal Reserve was still saying that inflation is transitory. And if you're like me, you were looking at how much you were spending per month and you're going, it doesn't feel very transitory. And we were all screaming inflation. And then they woke up early 2023. They jacked rates up. They went way, way, way up to combat this inflation thing. And that really put a lot of investors, it just froze them in their tracks. Should I do this? Is this going to make prices plummet? So the topic today that I want to give just a really fair look at is, should you invest in real estate right now? Or is it kind of feeling like the stock market where it's just really overinflated and it would be a bad idea to get in right now? That's what we're going to tackle today. Does it make sense to invest in real estate right now? And before I get into numbers or charts, I've said, I think investing with fixed rate debt makes sense because if rates go up, you'll be glad you invested. If rates stay the same, you'll be glad you invested. And if rates go down, you can refinance. And I think that applies to residential properties with fixed rate conventional debt. But let's be clear, values can and do go down in the short term sometimes. That risk is real. I survived '08 and it didn't go down just a little, it went down a lot. But historically, if you hold the properties long enough, values recover. So this episode today isn't about hyper fear, it's about thinking clearly, weighing those pros and cons and using real historical context. So let's talk about the emotional side. One thing I've noticed over the years is most people who ask, should I wait, aren't really asking a math question. They're asking an emotional one. They're worried about buying at the top and getting stuck with a bad deal, looking dumb in hindsight. And that's understandable. You don't want to be the sucker that, lost in musical chairs. Real estate's expensive. It's illiquid and it's personal. But here's the issue. Waiting always feels safer than acting until time passes. When you wait, you avoid short-term discomfort, but you also delay equity growth, rent increases, loan pay down, tax benefits. And the hardest part, you don't feel the cost of waiting until years later. And granted, our company develops and sells and granted keeps too income producing real estate. So everything that I just said may sound self-serving, but I really believe it. You look back, if you would have invested in that property in 2023 or 2024, let's just think about it. Do you regret that right now? My gut is probably not. It's certainly possible, depending on the market that it's in, that, you lost some value, right? But real estate is getting increasingly difficult to build and develop. So it's something that I believe, over time, you're going to recover. And who has that crystal ball of being able to project when, the exact right time to buy is? So we're looking back 2 to 3 years, and that's what investors should do more often. Interest rates were low. They were in the 3% range. People saying prices are too high, imminent crash, all the YouTubers and the doom porn people. But if you bought that small rental multifamily property 3 years ago, especially with that fixed rate debt, you're probably doing okay right now, right? So here's what likely happened to you if you bought 3 or 4 years ago. Your rents increased, sometimes dramatically, right? There have been markets where rents have softened by, 10% or so, all right? But if you had that fixed rate debt, you're controlling your biggest expense. Another thing that happened is your loan balance did go down. Your tenant paid that loan balance down for you. Inflation worked in your favor. Replacement costs typically went up. And even if those values have dipped briefly, they've largely recovered by now or will over the next couple of years. And so were there markets where returns were flat or messy for a bit? Absolutely. But for long-term holders, time did the heavy lifting. And that's the part that people underestimate. It's a cliche, but you don't need to time the market. You need time in the market because, and maybe this is mean for me to say at you, and I'm going to point at you, you can't time the market. You don't know what's going to happen. And we can come up with all kinds of reasons for why it would go up or why it would go down. But time did all the heavy lifting in this little mock scenario that I've just gone through with you. So let's talk about the case for maybe investing now. Fixed rate debt is still powerful. It's come off some from its highs after the Fed started hiking rates. But even at higher rates, fixed rate debt, it locks that payment in. It protects you from inflation, and it gives you optionality later. You're not buying certainty. You're not buying perfection. Number two, it's less frenzied competition. Do you remember how it was a few years ago? It was crazy, right? We would roll out investment properties, and all you had to do was wake up in the morning, you had a line of investors. So there's fewer emotional buyers out there. You can take your time, you can evaluate, you can do your due diligence, because even though I'm in the camp of you should be investing, I'm thinking you should be doing it right. You should vet those leases, vet those expenses like we talked about last week. So I said time in the market beats timing the market. Real estate is a slow game, an illiquid game, and it rewards people who stay in, not who can buy at the precisely best time. The longer you own, the more your rents adjust, and the more the debt erodes, and the less that entry price matters. I had a conversation with my property manager on a duplex that I own in Indianapolis last week. A lease came up for renewal. They recommended a $60 increase on the lease. The tenant took it. I mean, this is not flashy, but this has been happening year in and year out. So even if the value of that duplex is flat or declined a little bit, my cash position and the equity pay down has been fantastic. I wouldn't trade it. You can also refinance, but you can't rewind. If rates go down, you can refi. If they spike again, you can't go back and buy yesterday. So let's make the case for waiting, though, because, we can argue. There are markets that just seem really top heavy where maybe there's just a flood of supply, right? There's a lot of markets, a couple we operate in, I think Nashville and Dallas, where demand was pulled forward due to the ZIRP phenomenon, the zero interest rate phenomenon that people refer to. So let's be fair. There are reasons to wait. You've got that short-term value risk. Values can go down, especially in those overheated or speculative markets, and you need that liquidity in the first couple of years. So if that's a big concern, liquidity for you right now, real estate might not be the right move. Two, cash flow is tighter. Higher rates mean thinner margins. It requires more discipline. There's less room for error. You don't have that forgiving tailwind that we had from 2020 through 2022. You've also got that opportunity cost of capital. If you got really high interest debt, you got no reserves, unstable income, waiting and strengthening your foundation might be a smarter move. Get that balance sheet improved. Get yourself to where you can absorb some of those ups and downs that come with real estate ownership. And then time can be your friend. But if you've got a little bit of a liquidity or a balance sheet problem, your income is not predictable, I think it makes sense to hold here. You got to get your own house in order to be able to endure those ups and downs. So what doesn't get talked about enough, though, is that waiting has risk too. If you wait, rents might rise faster than prices fall. Construction costs might increase. Inventory might tighten again. Those rates, they could stay higher for longer than you expected. And worst of all, you might still feel uncertain later. That's happened to me before. I'm waiting for this magical time in the future when it's all going to make sense. And when that time shows up, I'm still going, it doesn't make sense. I should have just done the deal, right? So here's a couple of questions that I think are worth asking instead of, is it a good time? Should I wait or should I go? So instead of asking, is it the perfect time? Better questions are, can I hold the asset long enough? Is my debt fixed and is it conservative? Does it make sense without speculation? Meaning, does it deliver a reasonable cash flow with the principal pay down? I'm not counting on it to go up 10, 15, 20% a year. Are you investing based on fear or fundamentals? And I think that applies to, are you not investing based on fear and fundamentals? Or are you just looking at a numbers decision? Because when you look back 3 years from now, the question is not going to be, did I time the market perfectly? It'll be, I'm glad I own this asset. Or do I wish I had owned this asset? So I've seen it over and over. Investors rarely regret owning good real estate for a long time, but they often regret waiting for certainty that never came. Yeah, there's risk. Yep, values fluctuate, But with a fixed rate debt, with solid fundamentals and a long-term mindset, history shows that more often than not, time has been a pretty reliable ally, and you'll be glad that you bought that real estate. I hope that helps. We'll catch you on the next episode. Take care.